Good almost afternoon, everybody. Welcome to our next in the long series of Innova webinars. We're going to give it a couple minutes, allow folks to join who haven't joined already. So just stay tuned. For those who've joined the call, we're just going to give folks another minute and then we'll get going here. And Taryn, if you notice there's enough of a quorum, feel free to give me the thumbs up and I'll get going. Otherwise, I'll give them another minute or two.
Yeah, let's just do another minute.
Yeah. What do you think, Taryn? Give it a shot?
Yeah, sure. Yep. Why don't we get started?
Yeah, the first few slides aren't entirely substantive anyway. Welcome everyone to another Innova webinar. Thank you for joining here in the holiday season. I know we're all super busy with a lot of open enrollments and other end of the year activities and job tasks. So appreciate you taking a short time here with us over lunch to learn a few things and maybe we'll give you a few tidbits for some of those holiday parties. Everyone's talking about GLP-1s these days, so I'll give you a couple things here that you can talk about in those settings too. I was looking at the title here in this slide, and I was going to put in parentheses after navigating today's most pressing insurance challenges. I was going to put in parentheses beyond just premium increases because we know that's sort of the biggest insurance challenge that we've seen here this season on the medical side. But then I was thinking more about it. I'm like, well, what we're talking about here is what's driving those increases in premiums. So it's very relevant. And so I kept it as it is. Just a quick disclaimer. Obviously, this isn't legal advice, tax advice. Whatever you see here is meant to be general information. Certainly run it by your own resources if you'd like any tax or legal compliance advice. I am presenting today. Most of you probably know me, but those who don't, I'm the president of Novo Benefits Group, founded almost 10 years ago now. And we work with small, mid-size employers, for-profit, nonprofit, in helping them with their benefits brokerage and their fractional HR support. And let's see what else. We have grown over the years. We are now, I believe, the largest independent brokerage firm locally and locally owned and operated. In Massachusetts is where we are, although our employees are spread out among a bunch of New England states. You have any questions about us, feel free to reach out to me afterwards. Okay, a couple housekeeping items. So we're going to have a couple polls throughout, so we'll try to involve you a little bit in this presentation. If you have questions throughout, don't put them in the chat, put them in the Q&A, and then Taryn here can just interrupt me as it makes sense, and I can try to answer questions as we're going along. We'll also have a survey at the end. We'd just like to get feedback from you so you can let us know what we can do to get stronger and better over time. So the survey will be a quick one at the end. What's not listed on here is, as usual, we're licensed trainers for continuing ed, and so you'll be able to get continuing education for your PHR, SPHR, HRCI, all that. Those codes will also be at the end of the presentation, and we'll send the actual slides to you afterwards. Okay, moving along. This is our topics for today. I expect this to be 30, 45 minutes or so. We'll see how it goes with questions and such. Our topics will be an update on what's going on with the GLP-1 drugs in terms of what's happened over the last couple of years and what's happening practically now, what we expect to happen in the future. So we'll go through the GLP-1 update. We'll also talk about insurance carrier contracts. This is the contracts between insurance carriers and the providers out there. We'll go through what's happening there. Why is this year different from other years, and what happens when these disputes do not get resolved? What what do you do as an employer? What can your employees expect to experience? We'll then shift to a brief on the ACA subsidies issue. As I'm talking, I'm looking on the news to see what's going on with the vote. There's a vote down in Washington today on this topic. And so we'll see what's going on, but I'll give you a little background on impact to folks and more specifically the impact to employers and what you as employers might want to think about doing. And then lastly, we'll just spend a quick slide on what we see happening in 2026 and even 2027. So I'll do a quick preview of that. Okay, let's get going. Let's start with GLP-1 coverage trends. So to begin with, I know this is something a lot of you already know, so I apologize for that, but just want to make sure we're all starting from the same place here. So what are these GLP-1s? These are a class of drugs that were originally developed for diabetes treatment, specifically for type 2. Helps people get their A1C down. It's been very effective. It's come out in multiple versions, multiple manufacturers over the years. And what happened was they found a curious side effect where people were losing a lot of weight when they were on these drugs for diabetes treatment, which helped them with their diabetes, but also in general helped with significant weight loss. So thereafter, these drugs were modified and offered from a marketing perspective for other purposes. Now, it's really weight loss is the large other purpose that's been marketed under, but I did want to note here that as we keep reading about these studies, these GLP-1s seem to show evidence of helping in other areas too. So whether it's sleep apnea, metabolic syndrome with those risk factors, cardiovascular health, the GLP-1s are showing promise in a lot of fronts. I say promise because it's still somewhat early on in the life cycle of the GLP-1 class of drugs. So we'll see long term, but there is some growing evidence for it. That said, the manufacturers began to market these drugs not only for diabetes but for weight loss. And when they market them for weight loss, sometimes they'll have different ingredient levels, but they have different names. And so a lot of people don't realize that Ozempic and Wegovy have the same ingredients, same manufacturer, same ingredients. It's just marketed for a different purpose. They might have different levels of the ingredients in there at different dosage amounts, but it's the same ingredients. So Ozempic and Wegovy made by the same company. Similarly, so Ozempic is for, I should say, type 2 diabetes treatment, and Wegovy is the same ingredients, but built for and marketed for weight loss. Similarly, Mounjaro um, uh, created initially for type 2 diabetes. And then when it's used and marketed for weight loss, it is called Zepbound. All right, so that's sort of the genesis. The issue when it comes to employer plans is just the shock of spending. When we look at the list price of these drugs, they are plus or minus $1,000 a month. A common number I've seen is about $1,200 per month for a 30-day supply. And that's not the biggest issue. The biggest issue is that unlike other expensive drugs, which are meant for a short-term treatment and then you get off the drugs, these are meant to be very long-term. So you have to use them indefinitely. So, when it was introduced for diabetes is one set of issues, but the one that really pushed this over the edge was when it was found to be useful for weight loss. And because so many people were qualifying for this drug for weight loss purposes, the utilization has skyrocketed, and they represent about GLP-1s, that one class of drugs, about 20% of spending in employer plans. Been a huge driver for prescription drug inflation over the last couple of years. It's up to the one of the recent pieces of data I looked at about $30. This one class of drugs for both diabetes and weight loss, approaching $30 per enrolled person per month. So it does. I'm not talking about people who are using the drug. If you just look at a general employer plan and you look at each person on the plan, so employee, spouse, children, if you take the cost of this drug and you spread it out over everybody, it's looking at about $30 per person per month. That's how much these drugs are costing. And here it is in another chart. PMPM stands for per member per month. Per member is a person. It's an employee or a spouse or a child. And so you see the last so fast the cost trend per member per month. And that's because so many people have been qualifying for this type of drug so quickly on the weight loss side. So from 2022 at under $5 per member per month, and then 23 it started to spike, and then all the way to 24 spiked quite a bit from about $12 per member per month all the way to 25. And then in year 2025, close to 30. I think this was looking through Q1 of 25. When we looked at more recent data across client reports, it spiked even further in 25. So I imagine once the rest of the 2025 data, this dot right here is going to go to like over here. It's going to go up even further as we round out 25. And so all through 25, the market was evaluating, what do we do about this? And so that is where the conversation shifted because we have a dilemma here. On one hand, the short-term costs are really, really high. Um, and and uh, uh, and then we look on the other hand and we say, well, there might be a return on investment of these drugs. Look what it's done for diabetes. Look what it's doing for potentially for cardiovascular and sleep apnea and general weight loss is a good thing for so many other risk factors. But then the question is, well, when is that return on investment? Do we see that right away? In some cases, yes. Some cases, more long-term play. Then employers will ask, particular employers might ask, well, if we're going to invest in these in the GLP-1s for particular employees, will that employee be here long enough for us to realize the return on that investment? So is it worth us investing in those individuals to help them lose weight and control long-term risk factors if those employees may not be with us at this employer in the next couple of years? Now, I'm looking at it from an employer lens. From a public health lens, it's totally different. From a public health lens, you're looking at the overall population. And if it can be affordable, this drug would be potentially a positive impact on the overall health. But each individual employer is looking at their own risk pool and their own costs and looking at their own ROI with this. And in the meantime, when they're looking at this, they're thinking about, well, we've got our regular health insurance inflation at double digit this year. And so this is just adding more fuel to that fire. So this is the dilemma that's been faced by employers and the insurance carriers throughout the last 12 months in particular. So so then the question is, well, what are plans doing for 2026? So in general, what we're seeing, coverage for diabetes type 2 treatment for these GLP-1 drugs is still covered. We haven't seen any instances of where the class of drugs is just taken out of the formularies altogether. So coverage for diabetes type 2 still covered. What we're seeing though is on the weight loss side. And many of you probably already have seen this, heard about it, or have had to deal with the implementation. And I'm looking at plans here in two different ways. One is fully insured, another is self-insured. Fully insured is when you buy a plan from a company, from an insurance carrier, you ship all the risk to them, you pay premium. Self-insured, as most of you know, is when you're paying a third-party administrator like a Blue Cross or United or Cigna a fixed fee, but they're drawing on your employer general assets to actually pay the claims. And so it's working a little different depending on whether you have a fully insured or self-insured plan. In the fully insured market, we're seeing weight loss use increasingly excluded. So these GLP-1 drugs would be offered for diabetes, but not for weight loss. That's generally the default position that most carriers are taking in the fully insured market. And then from there, there's a divergence. It depends on the size of the group. When you have under 100 employees enrolled on the plan, that's typically one set of the block of business where the carriers will typically not offer any sort of weight loss rider, meaning the GLP-1s will not cover weight loss no matter what, even if you as an employer find it valuable and you want to offer it for whatever philosophical or financial reasons you feel like it's a good ROI, you're not able to generally in that smaller group market. When you're over 100 enrolled employees in across most states, so I would say this is always state by state, carrier by carrier. But in general, when you're over 100, the carriers are typically offering riders available so that you can offer these GLP-1s for weight loss as well under your plan, but it'll cost you. And the way they determine the cost, they'll either look at their overall risk pool or they might look at your individual plan. They'll look at your employees and their dependents and who's been using these GLP-1s for weight loss. And they'll come up with an actuarial cost for that to have that class of drugs included for weight loss. And so what we're seeing is overall, on average, somewhere between 4 to 10% in terms of the rider cost. So we're looking at total medical premium. This is not just on the prescription drug. If you look at your whole medical premium, they'll typically add another 4 to 10% on top of what you're already paying just to cover GLP-1s for weight loss. So it's a huge number, especially when we're all looking at such high increases in general inflation. So then what we're seeing from a lot of employers is when given the choice, many employers are saying, no, we just can't do that. We just can't have the employer and all employees pay this exorbitantly high cost for this coverage, even though it would help a certain select number of our employees. Many employers are declining that offer for the rider.
Eric, we have,
Taryn, any questions?
yeah, we do have a question.
Yes.
Do the carriers have any information about the impact of use of these drugs for weight loss versus offsets due to better health for those individuals, or are side effects impacting the better health of the individual insured?
Yeah, it's a great question. The question is about side effects and also the long-term health benefits. This is part of the dilemma. It's long-term. These drugs really have gained popularity in the last 12 to 24 months. So we're waiting on studies to show, is it really Is it really doing what it's purported to do in terms of long-term health? You'd think it would. You'd think that, hey, if people are losing weight, then it should help all these other risk factors. But in terms of the studies, we haven't seen it, and moreover, the industry's impatient. It's an impatient industry. When we're faced with double-digit increases in general, the prospect of adding on to that with additional cost is just tough for a lot of the industry and even employers to handle. So it's that impatience. But to answer the question, we don't have all that data yet in terms of long-term side effects, in terms of long-term impact, positive impact to those on these drugs. It's just been very positive in the short term in terms of impact. And moreover, there's going to be another round of GLP-1 drugs coming out shortly that have an additional positive impact. So we're going to see more investment in this class of drugs going forward. You'll also see not just injectables, but we'll see oral tablets that will also make it easier for people to access and perhaps less expensive. So on the fully insured plan, this is how it's working, depending on the size, whether you have that rider option. The cost of the rider is often pretty expensive, and many employers are opting away from it. On the self-insured plans, it's different. You, as this plan sponsor, you get to evaluate your own claims trends. You get to see who's using what. You can make decisions accordingly. You can talk about which drugs of the GLP-1s you would cover or not cover. You can decide what other programs you might want to implement as well. In fact, or you could decide to exclude altogether, like many of the fully insured plans are. So the self-insured plans get to go through the same sort of thought process, but they have a little bit more data at their hands and perhaps some other unique programs that they can implement. So regarding those programs, the marketplace is looking to um, continue the use of prior auth and some other programs to try to couple with the GLP-1 drug challenge. So an example would be if someone wants to use the GLP-1s for weight loss, they would also be required to participate in a lifestyle change behavior program to help them go through and maybe if possible wean off of the drug if possible. They might have some step therapies where you go from one drug to the next drug, like we've seen with other classes of drugs, to try to shift people towards the lower cost drugs. There have been instances where carriers are trying to negotiate with one manufacturer versus another to see if they can get the cost down. So those are interesting programs that are being implemented to couple with the GLP-1 drug. I thought this would be interesting just to note what other countries are doing. This isn't just a US thing. So other countries, as we know, are mostly government-sponsored health plans. So they're single payers in essence. So you don't have all the different employers making individual decisions. You have these countries making decisions for everybody. And so as I've been following that, it's interesting what they're doing. They're doing some of the same things in the U.S., where some countries might not cover it at all for weight loss, or they might have programs where they make the people first try something else, or in conjunction with the drug, they have to try some other lifestyle behavior program. But the piece I found interesting was them doing this phased rollout. So they will offer it for weight loss, but they will only do it for a segment of the population. So they'll look at the BMI and they'll say people that have the highest BMI, let's open it up for them, see how it goes, see what it costs. And then over time, the intent is to, or has been, to lower that BMI number so that more people would be eligible. So they're controlling the rollout through a more specific eligibility on who would be eligible for weight loss based on their particular risk factors outside of diabetes. So that was an interesting point and something that perhaps might develop in the U.S. They're also offering, they also require a lot of medical oversight. So some countries won't allow you to get this drug through a primary care script. You have to be in a program that's specifically for weight loss under medical oversight that way. So they're really tightening when you can get the script filled. So an interesting point of view that might be looked at by the carrier industry in this country, or at least some of the self-insured plans might look at, well, if we can offer it, let's try to do it in segments or roll it out more thoughtfully than opening up the floodgates as it had been until now. So in the case where these drugs are not covered, what do you do? Well, I mentioned retail costs are very high. So street price 900 to 1300 per month. That said, things are changing. They're changing rapidly. So the manufacturers are offering direct pay discounts. So if you go to a Novo Nordisk or a Lilly, they have programs. Lilly calls it Lilly Direct. And if you don't have the GLP-1s covered by insurance, they'll offer that same drug for weight loss at a deep discount in the few $100 range, as you see on this on the second little row. You have box stores also jumping into this, offering discounts where they can for certain of these drugs. So we're seeing a lot of direct to consumer pay programs, and that is going to be one option for people. We're also seeing compound pharmacies enter this mix. This is where they put together the ingredients and they sell it as a different name product. It's not governed by the FDA, so you got to be careful. I wouldn't necessarily promote this to employees. So, but that is out there. You should know that the compounding organizations are coming out with what they call comparable products to the GLP-1s that are out there under Novo and Lilly. HSA, FSA generally will cover GLP-1s when at a tax-free on a tax-free basis. Generally needs a prescription to get it. It'll all be subject to plan rules, so check your third-party administrator on that. But that's also something people should keep in mind if they don't have it covered by the insurance. At least they could get it for pre-tax. And then lastly, there was some federal action from the Trump administration. We'll see where this goes, but their efforts have been similarly to make a deal with the manufacturers to bring that cost down. I've seen numbers in the 100 to 200 per month range. So we'll see if that takes effect in 2026. So it's important to sort of follow this as it's changing pretty rapidly. You want to look at your own data. If you haven't before, you might want to ask, can we get a customized report? If you're 100 or more employees, you should be able to get reporting that says, well, what drugs are our employees taking? You could identify whether it's for diabetes or weight loss, largely by the name of the drug, as we talked about earlier, Ozempic versus Wegovy, Mounjaro versus Zepbound, or you can have them categorize it for you in the reporting. You can see how many people are taking it, you can see which drugs, and also look at the trending, because as I mentioned in 2025, it really seemed to grow quite rapidly. If you like to offer it and you can't through your insurance carrier, there are some employers that are using the HRA model, the health reimbursement arrangement model, where you essentially set up a self-insured pre-tax reimbursement program to cover GLP-1s for weight loss. I would just encourage you to think that through really, really well, because with that utilization going up, it's kind of it could be a Pandora's box of costs, because when you're doing it through an HRA, it's coming out of your general assets as the employer. There's no cap there necessarily, depending on how you set up your HRA. So be careful of utilization trending there. And then communicating the philosophy to employees is important. Each employer might feel differently individually, but as an employer, you want to be thoughtful and careful, because this is a very an emotional topic for a lot of people, and it's very important to a lot of people. So we've got to be thoughtful about communications and providing outside options, updated information as you know it. And then again, lastly, follow the changes in policies and the prices, because every couple of weeks it seems to change as we're following the news from the manufacturers, from the carriers, and from the state and especially federal government. Okay, it's a lot on GLP-1s. Just want to just take a second, do a quick poll, see what you all think, given what we were just talking about. So, Taryn, go ahead and trigger that poll.
Okay, one quick question that came up
Yep.
too in the Q&A. Someone's asking, when are they shutting off the valve? When do they stop covering?
Most of the carriers are stopping the coverage in 2026 at renewal. So if you renew January 1, 2026, they're usually cutting it off January 1. If you're renewing in the middle of 26, it's often at renewal, but you really need to check with your own carrier and your own broker and ask them to verify because it's been changing. Over the year 2025, the carriers were changing their positions. They would cover it for a little while longer. Then they said they'd cover one drug but not another drug, and then they changed the deadline as to when they'll cut it off. So you really have to check with your carrier, your plan, your renewal to verify. But generally speaking, renewal in 2026 is where we're seeing most of it terminate for weight loss. Okay, the poll. How likely would you be to add it? If it meant additional, we just called it about 5% to your premium. So you're in the driver's seat now. Those of you who are in fully insured plans haven't had this opportunity in the past to actually determine whether particular drugs are covered or not. So this is new ground. For those of you who are self-insured, you may have had these opportunities in the past. So we thought it'd be interesting to see where people are today. What's the temperature of folks? And again, the 5% will be across the whole medical plan, not just prescription. Yeah, interesting. We're seeing, not so much on the very likely, but you know, maybe and maybe not. This is consistent with what we're seeing overall. That a lot of folks might not offer it going forward when given the choice at that cost. So that's consistent with what we're seeing out there. Okay, we got a couple other topics to go through. Want to talk about the insurance carriers contract disputes out there. This is something that's been another driver of cost increases over time, and is something that continues to be a little bit problematic and perhaps more acute than it has been before. So let's just provide some basics on contracting. So when I talk about providers, in this context, we're talking about the hospitals, we're talking about the doctors, and just keep in mind when these doctors and hospitals negotiate for their rates, their pay with the insurance carriers, they're often doing it as groups. So there'll be a hospital network that negotiates together, or certainly provider groups. Providers will get together with groups and they'll act as a group and negotiate as a group. So it's not always one doctor at a time. It's very often practices or larger groups. And the hospitals, it depends if they're part of a larger hospital network or if they're on their own. But either way, whether it's an individual hospital or a hospital network, they're going to negotiate with each carrier separately. So they're going to have a negotiation with Blue Cross, then they're going to have a separate negotiation for their reimbursement rates with Cigna and United and everybody else. So Aetna and the local carriers. So they have these individual negotiations for how much they get paid for their services. And these contracts are generally on a 3-year basis. So every 3 years is when these contracts come due for renegotiation. And many of them have been coming up. Of course, it's not all the same year, so they're spread out. But the last couple of years, we've seen a lot of activity with these negotiations. Not only did we have GLP-1s impact rate costs for insurance carriers, but just provider costs have gone up. Through COVID, a lot of providers and hospitals took a lot of hits. What's really interesting, we'll get to in another slide, the financial pressures across everyone. But before we get to the financial pressures, just a typical timeline. Coming up on that 3-year contract renewal, the negotiations typically intensify. So a few months before the deadline, they get hot, 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 and then that's when those letters go out. The letters might go to patients who've been using those hospitals or doctors. They might go to members of insurance plans, and there may even be some media coverage. So those things happen as a result of a couple things. Number one, Sometimes state regulations require these notifications to go out, and there is thought among states that there should be more time, meaning the letter should go out even earlier. There's a pro and a con to that. If you send those letters out really early, as you all have seen, perhaps people get very upset, and more often than not, over time, these negotiations do end positively. And so there is a cost to giving people so much notice, and you get them all upset about things, yet the contract ends up renewing. But on the other hand, we want to give people time to be able to react and adjust. And oftentimes, those letters and the media coverage is just a negotiation tactic, whereby whenever there's news of a hospital potentially going out of network, then it gets the employees to talk to the employer, and then the employer talks to their brokers, and then the broker talks to the insurance carriers, and vice versa with the providers. But it's really a lot of pressure on the carriers typically to try to come to terms with those hospitals if they don't end up out of network. And then patients would be calling the hospitals and say, hey, are you not going to be in network? When are we going to know? What are we going to do? They're talking to their doctor. So sometimes it's a negotiation tactic. And then that deadline arrives, and you might have an extension of time. Some states require a cooling off period where it's a couple months before they terminate the agreement. More often than not, the disputes are resolved with a deal, and they agree to terms, the increase in costs. But once in a while, it ends with a provider being out of network. So what's different this year? There's more pressure than normal. Oftentimes, we've seen years where the hospitals claim they were losing money and they're under financial pressure, or another year where the carriers were saying we're not doing so great, or we're losing money. This year is interesting where we're hearing it from everybody and seeing it from everybody, from the hospitals to the insurance carriers. We're seeing numbers coming out where they're claiming to lose money. We're seeing layoffs on the provider side. We're seeing layoffs on the insurance carrier side. And keep in mind the results of all these negotiations is the carriers are passing it all through to employers and employees. So whatever rates are negotiated with the providers, the carriers then take that and they increase their premiums to all of us. So it's really a pass-through system. So while this is not something we're directly involved in as an employer sponsor, these negotiations directly impact our costs. So the carriers are trying to hold the line. They're looking at the health insurance inflation and trying to keep that under control. We do have more negotiations going out into the public. We have more of them reaching the deadlines, and we've seen more instances where providers here and there are just not coming to terms and they're outside the network. So that's what's different. It's more financial pressure and more instances of going to the deadline and even contract termination. So if a contract gets termed, what happens? Well, it depends on what plan you're on. If your employees have a PPO plan, they do have out-of-network access. But remember, if you're going to that provider out-of-network, you've got increased deductibles, you've got increased co-insurance typically. And then don't forget there's balanced billing. In an out-of-network plan design, the carrier has no contract with the provider. And so they have to pay the provider based on a benchmark number. And most carriers have moved to a multiple of Medicare, like what Medicare would pay, and then they'll pay a multiple of that, and that's what they'll pay out to the provider. So when you see like we have a deductible, we have co-insurance out of network, that doesn't even consider that those deductibles and co-insurance are based off of a benchmark number that's usually tied to Medicare. And so if the hospital is charging the bill is higher than that benchmark number, then not only does the employee have to pay deductible and co-insurance, but they pay the difference between the benchmark number and what that hospital bill would be. So the point is, there is a lot of costs out of network, but you do have that option on that PPO. You don't have it on the HMO or EPOs unless it's an emergency. Emergencies are covered as in network in almost every plan. That's pretty straightforward. The piece I want to make sure everybody knows about is the transition of care. So transition of care is a way that many carriers ease employees off of providers who are suddenly out of network. Transition of care often comes into play when you're moving from one carrier to another carrier for your whole population. So you're changing at renewal from a Blue Cross to Cigna. And you find that Cigna doesn't have this particular provider in their network that Blue Cross did. So then what do you do? Well, how about these people who are in the middle of treatment? What do they do? Transition of care is meant to sort of ease that for those kind of people. Those that are um, in treatment. So maternity is a common one. I have on here cancer treatment's a common one. You will have a typically, they'll often see maybe 90 days, or if it's a treatment, or maybe longer if you're in a certain trimester on maternity. But you'll have this time limited opportunity to continue seeing your provider and have it treated as in network, even though they're out of network. But it's important to know this requires an application. It's not automatic. The employee has to apply for this. So I keep thinking about this transition of care. We usually don't address this until there's a big problem at the when we find out that someone's out of network. But and that's usually a change from one plan to another. But maybe what we need to be doing is when people are getting these letters ahead of time, maybe we need to be focusing on transition of care a little bit more. That gets to the employer playbook here. So you can get reporting on this. So if you hear that hospitals is having contract dispute with your carrier, if you're over 100 employees in your plan, you can typically get some data and say, all right, I need to assess what the impact could be here. Show me how many people are seeing that provider within the last 12 months, what the claims totals are, and get that data if you can. Taryn, do we have a question?
Yes.
Yeah.
What underlying factors are contributing to elevated inflation within hospitals and insurers?
Hmm. That's a deep question. So the hospitals will say their cost of providing care has been going up. They'll say that the cost for nursing has been going up. The cost for their own employees has been going up. They'll cite that. Um, they cited a lot after COVID that there was a ramp up following that. And keep in mind, health insurance goes up because health care goes up. Health insurance isn't its own entity. It's a reflection of what's going on in healthcare. So as healthcare goes up, health insurance goes up. So and then among the hospitals, it's important to understand that they're not all the same. A lot of times, the hospitals that cost the most, there's pressure for them to bring their costs down, and those are often teaching hospitals. And then the teaching hospitals will come back and say to the carriers, "Yeah, we want to get paid more than the regional hospitals, but there's a reason." The teaching hospitals will say, "Well, no one's flying a helicopter to that regional hospital with somebody who's in great distress. They're flying the helicopter to us downtown, and when something goes really wrong." We at this big expensive hospital have to have every piece of equipment ready to go and every specialty ready to jump in. So that's sort of their argument as to why they should get paid more than maybe other hospitals. And so it really is a negotiation. So what do you do as the employer in this case? You look at the data if you're getting these notices that there may be a dispute and there may be someone going out of network. It might make sense to send some proactive communications to employees. Again, there's this understanding of you don't want to overreact, you don't want to underreact. So you've got to come up with something that's reasonable. Maybe, as I was mentioning earlier, we talk about transition of care a little bit earlier in the process so people know, well, if this worst happens and they don't come to terms, if you're in the middle of treatment, here's what we would be doing. We'd be having you go through this transition of care process. So that's important. And then you could always take particular people or high risk situations and handhold those through with your account teams, through your broker, or through your carrier rep. But it's a good question on the drivers. That's something we can spend a whole day on. But the bigger question here is access versus affordability. Um, We've always wanted to have everybody in our network. But we also want to have stable premiums. And so if we continue to expect that 100% of hospitals are going to be in network, we've got to also understand that this leads to higher costs because what happens is the carriers are going to be increasingly pressured to make deals with these providers and increase their rates, which then results in increase in premium to us. I can't tell you the number of times that carriers have come to me and said, we would like to be able to take a hard stand with this provider, but if we do, then we know that our clients are going to move from us to our competition. So they're really incented to make deals. So I just would encourage us to know that, or to think about whether we need to change our mindset on this. I know I'm taking a lot of time on these topics, but this is important. And we may see some state regulatory actions. The Vermont Department of Insurance came in and is trying to get involved in the negotiations between the insurance carriers and the providers. So I think I'm going to skip this poll, Taryn, just to get a couple more topics done because I wanted to stick as close to 12:45 as we can.
Yeah, makes sense.
All right, so the ACA subsidies, just a quick thing on this. I haven't been turning on my news while I've been talking, but there's supposed to be a vote on this today. A lot of those subsidies are expiring at the end of this year unless these are renewed. And that means premiums will rise sharply on those individual ACA plans. We expect increased uninsured people, already seeing it locally. And so in terms of the impact, as an example, in Massachusetts, lawfully present non-citizens under 100% of the federal poverty limit are going to lose their eligibility. Some middle income people at the 400, 500% of federal poverty are going to lose their subsidies. We're expecting that kind of impact to happen nationally. Even in this one state that our office is located in, there's expected to be hundreds of thousands who lose their subsidies, and tens of thousands have already decided to go uninsured. That's already happened in the first month of open enrollment. So what are you going to see as an employers? I would see more employees maybe asking to get on the group plan. You might see a cluster right now during open enrollment and more volume of questions. So if your plans don't renew 1/1, but they renew in the middle of the year, there's a question as to whether people can get on your plan if your renewal's not now. I think the answer may be no, but check with your compliance resources that the loss of subsidy may not be a qualifying life event on its own. So that's something to check on. One thing I just want to make sure you understand is CHIP, the Children's Health Insurance Partnership. Remind employees about that. If they're on your plan, they need subsidy. They can go out and to their state office and see if they can get help paying for their plan that they're paying for through their employer. So that's important. And then if you have an HRA, some of the states require deductibles to be certain levels. So if you have an HRA, it may require a little bit more work on your end. But the CHIP reminder is important if people are getting on your plan and they're low income. Okay, and then lastly, peek into 26, 27, inflation's still going up. We expect that to continue for at least another year. There'll be a focus on mid-level claims. There's a lot of those happening. Prescription drugs, I think on the good news side, if the GLP-1 for weight loss is being curbed, that should help on the inflation. We're also seeing biosimilars continue to be introduced, which allow for lower cost drugs that do the same thing. And then we do see employers exploring all sorts of alternatives, whether it's ICHRAs, where they reimburse for individual plans, group captives, self-funding, some creative network designs where you're incenting people to go to one provider versus another. Okay. Lastly, I want to just end by reminding you that our webinars are posted on our website. You can get it there. We're going to have a survey now. Taryn, you want to trigger the